conversations. As in the past, we have set aside the whole day to be able to answer all the questions that you have, and we'll be able to, and we're prepared to do that. What I would like to do is to start off. We have had some questions sent in advance, and these were from Wallace at Steyn, at Steyn Capital. Guys, we see a lot of names that we know and recognize, so welcome. Thank you for joining us. So if I can go through these questions first, and then we can take some of the others. So the first question is about the sustainable EBITDA figure for Goldrush, which we used on our latest valuation of 331 million. And the way we got to that was to take the 6 months actual trading EBITDA, and then there was some accounting benefits that came in at year end, which we excluded because it applied to the full year, and then we doubled that actual trading EBITDA to get to 331 million. So Wallace says this, obviously was achieved with restrictions in place. So once these restrictions are lifted entirely, do we expect to see a significant higher sustainable EBITDA figure, or will costs be creeping back into the, to offset that? So my sense is, and I mean, we've seen that happen in the business. I think there were permanent cost reductions that happened as a result of COVID, not only in Goldrush, but in many of the other businesses we see. So we think, once we have proper vaccination and that the lockdowns are less severe, or that especially the curfew, which at the moment, is still at 10 o'clock, and in our bingo halls, the best trading time is after 10 o'clock in the evening. So once we see that lifting, we definitely think that the sustainable EBITDA number is definitely, higher than the 331 million that we've used for our valuation in March this year. The second question is, what timeline are we looking for rolling out of the remaining limited payout machines? So you'll remember that we have 4,200 LPM machines approved throughout South Africa, and we have, as we disclosed in the past, we have access to another 1,000 machine license in the Free State, and we're at about 2,200 machines at the moment. So these rollouts are dependent on regulation and regulators, and it's also dependent on availability of machines and obviously the amount of capex we want to spend in the business. I would say it will probably take us another 4 or 5 years to get all of those machines rolled out. The idea is not to roll out the limited payout machines at any cost. The conversation we're having with the LPM division management is that we'll only roll out those machines where return on capital beats our hurdles. So it's not, a question of rolling out in a questionable site. We'll rather roll it out where we can make the best returns on that. The third question is, outside the rolling out of remaining bigger licenses and the LPM machines, where do you see the other opportunities for growth? Megan, I think this is where I'm going to invite you to just unmute on your side and perhaps, help us with that part of the question.
Yeah, thanks, Jan. So besides just rolling out the existing bingo licenses, we do have the opportunity to, optimize the existing licenses as well in terms of location and the number of EBTs as well. Due to the pace of the rollout, in KZN, we don't feel we optimized all the sites perfectly. So, we do think that's an opportunity for us also with, the average return in the LPM division as well. We have bid for, 8 new betting licenses in Gauteng. The Gauteng Gambling Board, has been suspended, and there's a new gambling board coming in. So that process will continue towards the end of the year. We've bid for 8 licenses. We don't know how successful we'll be, but that's an opportunity as well. And, I think, outside South Africa, we are pushing the online business, but it is a very competitive market out there with quite a few established players. And, in terms of, SA, unfortunately, there's very limited opportunities. There's a few players in the market, but, they've got quite high expectations in terms of price for acquisition. And in terms of bidding for new licenses, there's not much opportunities out there in terms of the current SA market.
Thanks, Max. So I think the confirmation there, Wallace, is that the existing business will be able to grow, and the online business is the bit where further growth will happen once the machine that we've built over the last 10 years have come to its fruition. But Megan, perhaps you can help us there. There's still quite a number of years of growth left in what you've built so far.
Yeah, so we spent quite a bit of time in the last 10 years just rolling out existing properties, and it didn't have the opportunity to grow organically as yet. So as a result, we still see the average revenue per machine and per bingo site still being relatively low. So there's quite a bit of room for growth in terms of the bingo space and the online and the betting space in terms of just that organic growth.
You can see Mergen isn't used to being in charge of a listed company. He's not as hyped up as some other CEOs might be.
I see there's some hands up. I'm just going to finish with these questions quickly, and then we'll take the hands one by one and go through the questions. Wallace has got another question. Is there an opportunity to flip the minority interest in Gold Rush to a group level? So, Wallace, I assume you are referring to minorities in some of Gold Rush's subsidiaries. That's a tricky political question. So I think there's no short-term opportunity for that to happen. But moving one level higher, is there an opportunity for minorities in Gold Rush Group to become fellow shareholders in RECM and Calibre? That's an opportunity. But I think the minorities in the Gold Rush subsidiaries, that's politically quite difficult at the moment. The fifth question, do you see legislation of online casinos as a likely eventuality? And if so, who will be allowed to operate them? Megan, I'm going to ask you to come in on that as well. My view is that basically all the online operators in South Africa are very close to online casinos in terms of the products they offer. I think that's only poker as a casino game that's not offered online at the moment.
Yeah, and right now there's so many different views floating around among all the provincial gambling boards in terms of how online should be regulated going forward. There's views that existing operators should all be granted online licenses. There's other views that it should be a competitive process run through national as opposed to the provincial gambling boards. Right now, unfortunately, there's no real working document out there in terms of how it will be regulated going forward, or even if it will be regulated going forward, besides how it's currently regulated among the provincial gambling boards. So right now, I guess the easy answer is we don't know what the future is going to hold for online and how it's going to be regulated.
But practically, for anybody that want to open an online casino, there's not a lot more they will be able to offer than what is available in the market already.
Well, pretty much, online betting right now very much mimics an online casino. And how online gambling operators are allowed to do this is that in the National Act, it's allowed for betting operators to bet on any contingency available. It doesn't need to be a sporting contingency, so it could also be a casino contingency as well. That's why you see a lot of online operators out there now offering games that are very similar to casino games or betting on the contingency of those casino games. So they're doing it through their sports betting license, not an online casino license. For how long that's going to be allowed, unfortunately, we're going to have to see what happens. I think casinos are very unhappy with betting operators betting on casino games. So we're going to have to see what happens in the next, 6 to 18 months and how, that landscape evolves.
Excellent. Thanks, Tom. I think we've come to the end of the questions on the RAC side. There's a few Astoria questions which we can take later. On screen, there's a question from David Eberol, and then Willem Hertzog's got his hand up, so if you can just allow Willem to unmute. The question, David, is about how long are we going to keep the preference share structure? And I think that's a fairly short answer. I mean, there's no intention to change that shareholder structure. RAC was set up in a very specific way, for a reason, and that hasn't gone away in our minds. So, the preference structure will remain. Pete, I don't know if you've got any.
Yeah, and it has been useful in terms of allowing Goldrush to get on with building a business almost from scratch in the past 10 years. And has shielded them from any outside influence, and they've been very successful in building a substantial business as a result of the protection that we've offered them. So it's been very useful, and we see no reason to change that.
Thanks. Wilhelm, I think you will be able to unmute and ask your question.
Yes, thanks a lot for the opportunity. Just a question on, looking at Goldrush's rollout of EBT sites and LPMs, one's implicit assumption is that typically businesses roll out their best sites first. So I'm trying to get a sense of, will the sites which were rolled out later and brought into operation later potentially generate lower revenues per site than the ones which were rolled out earlier? Or is that not necessarily the case because rollout was driven by regulation and, for instance, the call it impasse in KZN, which was ongoing for some time. So if you could just give me some guidance on that, that would be helpful. Thank you very much.
Max, I'll take it, and if there's anything else, jump in. But my sense for Willem is that the way that sites in South Africa were rolled out was very much driven by a regulation, and when the regulators allowed you to do it, rather than picking the sites ourselves. So obviously Goldrush rolled out their Gauteng sites first, because that was the first province where it became legally viable. And the sites we rolled out last, literally all of them are in KZN. Everybody in the gaming industry will tell you that KZN has a strong propensity to gamble and has a strong market. So my sense is that the last sites are probably as good as any of the others. Megan, do you see it the same way?
Yeah, and there's quite a few good sites that were rolled out in the last 12 months to 24 months. Unfortunately, we didn't have the luxury of choosing the best sites to go first. Sometimes we had to wait for the best location in order for it to be rolled out, and that meant waiting for a bit of time. What's important is to note is that half our sites are less than 24 months old, so they're still going through quite a large growth phase. And of the sites that are less than 24 months old, we've been pretty much in lockdown, COVID for the last almost 18 months. So a lot of those sites are only starting off. So in terms of that, the short answer is no, definitely not. There's quite a few good sites in our last batch of 24 months, and even before that, those sites that were opened up pre-24 months still are far from their peak in terms of their potential revenues.
How does that answer change or confirm the LPM side, Megan?
It's a bit different on the LPM side because the LPM side is quite competitive in terms of the number of route operators out there competing for sites. The good thing is that we still see a good demand for LPM sites, and we've been increasing our average return per LPM consistently over the last 3 years. So that shows that we're getting better at choosing the right sites and also increasing that average return in existing sites over the past few years as well. So, I would have been worried if, we rolled out sites and our average LPM started reducing as we started increasing the number of LPMs. But we've actually seen the converse where, as we've been rolling out these LPM sites, our average revenue per LPM has actually been increasing.
Thanks. Lalama, I hope that
Okay.
gives it. Any more questions
Yeah.
from your side?
Thank you very much. Thanks a lot, guys.
Excellent.
I think if I can just comment on Goldrush, it's gone through a very tough year. Over the past 12 months, we've had 3 different lockdowns of varying intensity, and the business has come through with flying colours, and I think it's proven to be a very strong asset. So we're actually looking forward to the day we can trade without any lockdowns. It'll be quite interesting.
I'm just reminding if there's, oh, Charles. Charles, we'll just give you a chance to unmute there. Charles, if you just want to unmute, you can ask your question.
Charles, I think you need to unmute on your side.
Yeah. Well, I think the question's gone. While we're waiting for any more questions, you're welcome to type it in the Q&A box. Charles, if it doesn't unmute, don't you want to put your question in the box, please? So thanks. We've tried on this side. So while you do that, let me just answer 3 more questions which came through, which was related to Astoria. Now remember, RAC still owns 9.9% of Astoria, and obviously after the unbundle or the distribution of the Astoria shares, we're involved in managing the capital for Astoria as well. The first question is, what options are you currently looking at to bulk up the business? Now I assume that, well, as the question is, to get the asset base bigger, you would notice that Astoria either has or should be putting out an announcement and an update on its net asset value today. If you have a look at that, the net asset value is already somewhat larger than you would have seen the last time. So I mean, for us, the most obvious way is to get scale benefit is to grow the net asset value per share quickly, and that will help us solve that problem. And then mathematically, the other option is if we get other assets that are cheap enough so that we don't dilute the net asset value per share when we do any transactions. Now, at the moment, Astoria is trading at a big discount to its net asset value. So, those opportunities are few and far between. But at some stage, we reckon we'll get those opportunities and we'll do the right thing when it gets to that. Pete, you look.
Yeah, I guess we are looking at a few potential transactions, nothing firm. They're all, there's a long way to go before we can even start thinking about how to finance them. The fortunate thing is that in South Africa right now, there are many companies that are, especially smaller companies, that are trading dirt cheap. Astoria is one of them. But if a potential target for us is as cheap or cheaper than us, then we can do a paper transaction without any dilution to shareholders. So that's a possibility. Also, Astoria has very limited debt at this point in time, so it has the capacity, it has cash generating assets, so it has the capacity to take on debt as well. So, we have, for the right target, we have financing methods. We can finance a transaction. And
Astoria also owns assets that are dividend paying, and we are getting cash back at the center. So I think that, that ties into that question. And then there was a last question: how much of an impact would the proposed firearms control amendment bill, if passed, have to OIH's business? So obviously, if that bill is passed, it will have a material impact on Outdoor Investment Holdings' business. It's not a risk that is new. The management team has been aware, and we as shareholders have been aware of that for quite some time. So, the teams worked very hard to diversify the business away from the guns and ammunition side. Remember, OIH, especially in the safari and outdoor side, you have the stuff that you sell behind the counter, which is sort of under license, but we also have a large part in the shops that we sell, which is not under license, which is the lifestyle and apparel and brand, where, stock turns are better, margins are better, and they've been very successful. So it definitely will have an impact, but it's very unlikely to kill the business. And it's not a risk that we're unaware of, neither is the management of that business.
Yeah, and I think management is also part of a very strong lobby group against those regulations. So they're actively lobbying against them. And I think, as you all know, events over the past few weeks in South Africa has probably strengthened that lobby's hand.
very likely. Charles's question there deals with whether we have a view if the discount is to do with a holding company structure or a reflection of the state of the small caps, etc. So, Charles, I guess your opinion about why RAC trades at a discount, is as informed as ours. I think it's a combination of all of that. What investors, potential investors, and existing investors tell us is, it's got to do with small cap, with liquidity, with the ordinary and the pref share structure, with the management fees. I mean, I can give you a list of all the stuff that people tell us that's wrong and doesn't work in there. So I think the discount is captured in all of those. Peter, you want to add anything?
Yeah, look, the bottom line for us is there will always probably be a discount on the RAC share price relative to its underlying intrinsic value because of those factors. Should it be 50% or 60% on an asset which is valued on a really strong asset which is valued at 5.5 times EBITDA? That's for shareholders to make up their own minds. We think similar businesses overseas trade at between 10 and 20 times EBITDA, easily, gaming businesses. Whether that's right or wrong is also, you have to make up your own mind about that. But we think RAC owns and controls a very strong business run by really good management. And yes, there is a holding company structure on top of that, but that, that is what it is. It's not a secret that has been sprung on shareholders. It's been like that from day one. Everybody's bought into the share, knows that is the fact, including us, and that is how it's going to stay.
I think we should give a few more minutes or so for any other questions that anybody might have around that, or any other point on the side. I think that just a bit of a further update is that Gold Rush has replaced their bankers in the last year. So, and I think it's important to make the point is that we've got RMB on as the bankers for Gold Rush. And the important thing is that we've structured the debt facilities in Gold Rush in such a way that our experience in dealing with this past month's lockdown was very different from a year ago, in that our financiers were involved in planning and understanding, what a business like this needs at a time when all your operations are closed down, the cash is sent back to the Fidelity, and we switch off the air conditioners. Whereas in the past, our financiers were not that understanding, which meant that the management team had to spend a lot of their time every week, keeping financiers calm rather than running the business. So I think this time around, the financial structure, the debt structure, the undertakings, the ability to pay dividends, all of it has been worked and negotiated with our funders, and we're very comfortable that that's in place. Perhaps the other question we get regularly is about what's the intended debt levels for Gold Rush going forward. If the stated aim is to get the debt to EBITDA down to 1 times debt to EBITDA, so the plan is not to pay down all the debt. A business like this can handle debt on the balance sheet to improve the returns of equity. But it also means inside of the MOI of Gold Rush, we have a hard limit of debt to EBITDA of 2 times, which means that if Megan and the team finds any assets that they would like to acquire, they've got 1 turn of EBITDA, which is quite a large number in the South African context, then to make acquisitions without having outside or requiring shareholder funding. So that's the plan there. Charles, thank you. It's definitely our idea and intention to give much more detail about Gold Rush. For now, RAC is classified as an investment entity, and we've got fair value accounting. As and when we finalize selling all the other assets, it's not an investment entity. We'll start consolidating. We're creating a bit of a headache for Megan and his finance team because they will have to get their financials now ready and audited, much sooner than they had done before. So they've had a heads up. So we expect to be giving a lot more detail. In fact, at some stage, consolidated accounts for Gold Rush going forward. David's got another question. We're quite bullish in South Africa. So what are we seeing in our businesses in terms of the ability to reinvest earnings and generate incremental return on invested capital portfolios? Look, I think in this context for RAC, the opportunity for reinvestment is inside of Gold Rush. So where capital is going to be invested in the next couple of years, basically there's maintenance capex when it comes to the bingo halls. That's not major. I mean, that's maintenance. We can spend growth capex at rolling out more limited payout machines. And there we have the internal model of what returns we are requiring, which is in line with what Gold Rush have been able to deliver in the past. And beyond that, there's a little bit of growth capex that can be spent on the online gaming business. But the nature of online gaming means that whatever you spend, that money goes to Google and Facebook and influencers and marketing expenses. There's not a lot of physical spend that goes in there. And there is a bit of a land grab going at the moment in the online space. As Mergen has alluded to, the online gaming business is quite competitive, and we are seeing quite a number of international players in the South African market. So that's the one opportunity. Gold Rush is not looking to invest capital outside of its circle of competence. So if we cannot find opportunities to invest capital in South Africa at the returns that we are used to, that money will be returned to Gold Rush shareholders, which is RAC. And RAC then has a priority. Our first order of business and our commitment to our bankers is that we will look to pay down some of the debt at the centre. If that is not the case, then we would be looking to buy back RAC preference shares in the market. If that's cheap enough, and if none of those options are available, then we'll deliver and pay those dividends straight through to our shareholders so that they can invest it for themselves. So in terms of Peter and my responsibility at RAC, it's a question of whether we pay down debt, buy back shares, or pay a dividend to our shareholders. Do you agree?
Yeah, no, I agree. I think that's exactly right. There might be some acquisitive opportunities also for Gold Rush, possibly down the line in terms of capex, but we'll evaluate them as they come past. So there are opportunities, but David, just to say your point that we are quite bullish on South Africa, I think we are bullish on the opportunities for some of our business in South Africa. I wouldn't quite say we're bullish on South Africa. I think there's a lot of things that need to happen on the political and financial front for us to turn bullish on the country at this point in time. That's probably a bit optimistic. But our business is operating well, despite what's going on in the country. There's demand for their product, and there are growth opportunities for them within this constrained economy. So we are bullish on the prospect for our businesses, but not necessarily on the prospects for South Africa per se. There's a difference.
I think it's important, if you play a game and you want to win, you need to understand the rules of the game and you need to understand the field. And I guess, we, by virtue of having operated in South Africa for a long time, we think we have a sense of what the rules of the game are and how to operate. Playing the game here, whether this is a game you want to play for 50 years or can play for 50 years is a different question. Shoaib, look, originally the plan was to get, Mergen will tell you, when we sat down many moons ago, we all agreed that Gold Rush would be listable by, was it August 2018, Mergen? And I think we got there in that the business was listable. In the meantime, I think the Gold Rush management team got a bit allergic to the idea of being listed and having to deal with everything that comes with a listing part. Mergen, is that right?
Yeah, and we're very comfortable spending most of our time running the business, stuff we enjoy, and we leave you with all the difficult stuff.
The stuff we enjoy.
Yeah, exactly.
So I think the answer is, the plan originally was to list Gold Rush separately. What has now happened is that Gold Rush basically has been listed, and remains listed in the form of the RAC preference share structure. What has happened is we didn't take 6 months out of the Gold Rush management team to go on road shows, entertain investment bankers, and try and drum up support from retail investors. And I also don't think that our game is one where we try to excite retail investors, to build up the profile of the business. If we look at the shareholder register that REC has, if we look at the interactions that we have with our shareholders, it's people that know and understand the business that we get on with, that respect, the team at Gold Rush. We're comfortable with the setting. Yes, we all would like the REC pref share price to reflect the underlying value a bit, better, but we'll get there. In the meantime, when the share price, got to levels that were sort of R8.50 last year, we took the opportunity and bought back just short of 10% of the company at a very good price. So, it also creates an opportunity for investors in that process. So yeah, I think going forward, this is the structure we have, and Gold Rush is not going to be listed separately. Wilhelm, on your comment, absolutely. We'll split out, the REC side and the Gold Rush side separately so that you can have a full look at Gold Rush itself. Charles's question says, what is sustainable maintenance capex? Charles, I think, on the bingo side, we're looking to replace either replace, renew, or move 2 bingo halls per year. And in the current, cost structure, Merck's helped me, but it will cost about 10 million rand a machine. Not a machine, 10 million rand per site to renovate. And then also our machines, we depreciate over 7 years, but they last a bit longer.
Yeah, and pretty much spot on. I mean, we plan, or we're budgeting to move and optimize about 2 bingo locations a year, but that's not a guarantee, right? The only time we're going to invest that capex is if we find a location or a site that meets our required returns. So although we do have it in our forecast, we would like to achieve it, but only if the right opportunity comes along. If it doesn't come along, then we'll just wait a bit until that opportunity does come along.
And I think Charles, if you want to get a sense of replacement capex, I think, depreciation is somewhere around 100 million rand a year, Bergen?
Yeah, it's, close to 120 million, between 100 and 120 million years of depreciation. So yeah, we should be spending a bit less than that in terms of replacement capital.
Yeah, so I mean, but once we've got everything rolled out and at steady state, I think that's a good indication for you for, in this business, your depreciation number does approach replacement, that you can't get away from that.
Right, it seems that another minute or so. Okay. Right, it looks like that those are all the questions. Some nice ones there, so thank you very much for those questions. Before we say goodbye, I'd just like to make mention, and you might have seen this in our annual report, or integrated report as it's called these days. There have been some changes at board level at REC. This year we've said goodbye to Gerard Swiggers and Tennis de Bruin, who have resigned off the board, and we would like to thank them very much for their service over the past 10 years. They've both added tremendous value to the business, and we appreciate that very much. And I think you'll join me in saying thank you and for their services. And we will definitely still be staying in touch and communicating quite regularly with them, because we do value their inputs. And then just in connection with that, Danny Naidu from Mazars has joined the board and will head up the Audit and Risk Committee. And I have also stepped down as the Executive Chairman, and Zanele Mklala has taken over as Chairman. She's the CEO of Merafe Resources as well, and she's a very capable person to run the board of REC. So those are the changes at board level, for your information.
Yeah, I just want to echo Pete's comments. Tianis and Gerard, thank you very much for everything you've done, not just for REC and its shareholders, but in supporting and helping us and running the business. It was incredibly valuable. We've also enjoyed it, and we look forward to that interaction going forward, even though you're not on the board anymore. And to Danny, welcome. Thank you for being prepared to go through probity. I still don't think you know exactly what it means, but you're already on the board. It's too late to quit now. I see Charles has asked whether you can ask Astoria questions. Absolutely, Charles. We have the time, and we can answer any of those questions. I think just to make clear that, remember, Astoria is a Mauritian domiciled company, and it's managed out of Mauritius. So, whatever comments we make here on behalf of Astoria, Pete and I are advisors to Astoria, and the decisions ultimately gets made by the board in Mauritius.
So I don't think Charles can unmute himself, so we'll just wait for him to type the questions on Astoria in. So if you'll bear with us for a minute or two. If you have more than one question, Charles, type in one so long, and I'll start answering that. Okay, there's one.
So the growth opportunity for ISA is, on the first leg, is it's got unused capacity. So ISA's got 2 campuses where, in the current setup, we think we can teach about 300 students per campus. So we've got just over 600, and that's full-time students, plus a number of other courses. So the next opportunity is to be able to use technology and our ability to schedule to be able to handle more students with the same infrastructure. So that's definitely one opportunity where we can sweat the opportunity more. But the second leg is, and this is what the team does all the time, is to be able to develop and introduce more specific qualifications or courses. And I need to be careful here, because in the education space, the word qualification means something very specific. So I'm talking here, as an investor, the idea that you come and study at ISA and you get, a qualification that gives an opportunity to make a living. So definitely developing and introducing more courses, qualifications over time. Obviously, the reputation has been built over 40 years, and it's all based on the quality of the brand and the education that our students get. And we need to maintain that. And the other question is whether South Africa is big enough to handle more than 200 summa theology students coming out of an institution like ISA. So we will definitely be looking to train students in ancillary fields, which is related to health, beauty, and wellness. The second opportunity, which is around, is obviously for ISA to develop its own skincare and other product range over time. Now, that's not a quick and easy process, especially because ISA is very infatuated with doing stuff in the right way and having the right quality. So it takes time, but that can be developed to do that. And then ISA can invest in other ancillary areas in the market as well. So we think there's a fantastic opportunity for ISA to grow and to generate the returns on capital that we are looking for.
In terms of the case of students there, Jan?
Yeah, I disagree with that, Charles. Under lockdown, when you incur the premium cost and you cannot leave South Africa, that might be the case. Our view is that in a world where more and more people are spending more and more time on devices and in working from home and removed from other human beings, that fundamental need for human contact and touch, is not going to go away. So the opportunity for our students to make a living is actually better, because what they do is exactly that, is to be close to human beings, to provide care and touch. in the 40 years of history of ISA, what has happened is most of the second-year students would have been signed up on international boats, and they would leave South Africa and they would earn very good income straight after finishing the education with ISA. And when you come over to one of the campuses, we can take you through it. But there's many stories that abound of students that finish the qualification, leave, earn enough money to come back, having paid down student debt, and have money spare to be able to buy either a motor car or a flat or a living space. So if as a student you only practice in South Africa, I think you might have a point, but the qualification actually allow our students to go and earn money outside of South Africa, which is one of the draw cards for an Isaac Carstens qualification.
So in terms of Rudy's question, Victoria, what is our strategy with Afrimat? We have the highest regard for Afrimat's business and its management. So we view it as a long-term holding, but it has to compete with any other investment we might contemplate making. So if something comes along that we think is better than Afrimat, we could use it as a liquid asset to finance such a transaction. But as you might understand, that creates quite a high hurdle for any other investment, because Afrimat is a fantastic company. I think over the past 10 years, it's outpaced Naspers even in terms of total shareholder return. It is a brilliant business with brilliant management, but it can be used as a financing mechanism for another transaction, but the hurdle rate is very high.
Which is not a bad problem to have. And I guess we are not the only people that have that view in that regard of the business and the management team. So there shouldn't be anything controversial in our opinion there. Do we have a view on an exit strategy for OIH? Look, we don't have an exit strategy for OIH. I think if you look at the history of this business, and I will encourage you to read our annual result or half-year results when it's out next week. Sometimes it takes time for good businesses to hit their stride. And what we have in OIH is a business with a management team that is passionate about their business, that understand and live the brand, that have proven that, with our input, they have been very good capital allocators. They have been able to acquire new businesses, grow organically, expand their brand reach, pay dividends, buy back shares. They've basically done most of the things that you would expect a very good management team to do. So normally those are the kinds of assets that you don't walk around thinking about selling. We have received our regular annual dividends on top of the reinvestment that the management team have done in their own businesses. So from our side, there's definitely no need or intention to exit that business.
And I think that's one of the strengths of our structure, as opposed to a private equity business. We don't have to exit. We can stay in forever.
Sure. I'm glad you found the feedback on ISA valuable. Geez, Charles, how much time do you have? Yeah, look, this is a public forum, so what we've learned is turnaround is difficult. If we haven't learned that before, and you would, having been a friend for a long time, you'll know that we've tried quite a number of these. So when turnarounds work well, they can be rewarding, but CNA just confirmed again that a turnaround business is very difficult. The other bit that we've learned is that we have had lots of advice from people on different levels before we actually committed to the investment. And what it meant is that we have been able to structure Astoria's investment into CNA into such a way that in essence it provided us with a call option on the turnaround working well, which means that if it did work well, we would have owned 70% of a going business, and if it didn't work well, basically we lost our call option or our option premium. So
very low premium,
which was a very, very low premium. So basically, we've learned a hell of a lot in structuring. Obviously, the other bit is we've learned more about retail, having been an investor and a shareholder in OIH for quite a long time. We knew a bit about retail. CNA has taught us some other angles. I definitely have the ability now to read retailers' income statements and balance sheets and financial statements in a very different way, which helps us. And there's no immediate benefit to you as a historian or a REC shareholder, but that definitely helped us in understanding that. And then with the greatest of respect, it proved that you need good business, good management, and good price for things to work out well.
2 of the 3 isn't good enough.
Yeah, 2 of the 3 is not good enough. It's easy to say, it's difficult to do, but it doesn't deter us from trying. Alistair's asked, does the Family Pet Centre plan to open more branches? If so, what sort of pace will they be rolling at? Look, if the Family Pet Centre is up to 4 branches at the moment, we know that the team has identified another 2 spaces already. That's in the process of being considered and the business plan rolled out. The speed with which we roll out, or they roll out the branches, is all about return on capital. The one bit that we've noticed from the OIH management team and the discipline that they have in there is that if a site doesn't promise to generate the right returns on capital, they've been incredibly disciplined at saying no. So the FPC will not roll out branches just for the sake of rolling out more branches, especially because there are lots of people entering that part of the market at the moment. We get the sense that lockdown and people spending time at home and seeing their families interact with pets have convinced them that a pet shop or a chain of pet shops or specialty stores is a good investment case. So we know that there's plenty of capital coming into that area. And therefore, we bet on the discipline, the capital discipline that this team has shown over the years, not to roll out stores just for the sake of rolling out.
Especially, I mean, the FPC is a big box format. It's not like rolling out 100 KFC shops. I mean, if you decide on the location and you want to put a shop, it's a significant investment in working capital. So they're very cautious about that.
Thanks. If Charles is signing off, then I take it that most of the other questions are gone. But shall we take last rounds of questions before we sign off?
Yeah.
If anyone else has got any other questions or comments, as you know, we are here, we're available. We try and make this meeting once a year to answer all your questions. We don't do roadshows, but we are always available for a question or a comment or try and get the answers to you. Megan, thank you very much for joining us for this meeting today. We will leave you in peace until this time next year, and we'll deal with the rest of the stuff for now.
And then we can share the good news with our shareholders in a year's time.
Yeah.
For leaving you in peace. Okay, well, I think that brings us to the end of the meeting. Thank you very much for joining us, for spending some time with us and to share what we've gone through over the past year and our findings and results. And we look forward to speaking to you again in a year's time. And in the meantime, we will communicate you with our interim results for both Historia and REC. Thank you.
Thank you.